Good morning, everyone. Thank you for coming to the bank's Financial Stability Report press conference. On my far right, I have John Cunliffe, Deputy Governor for Financial Stability. On my left, Sam Woods, Deputy Governor for Prudential Regulation and the head of the PRA. And on my right, the Governor, Mark Carney.
Thank you, Mike. Good morning, everyone. The FPC seeks to ensure that the UK financial system is resilient to a wide range of risks that it faces. And over the past 8 years, that resilience has been significantly increased. For example, with Tier 1 capital, the Tier 1 capital ratio for major UK banks now standing at 15.7%, losses that would out the entire capital base of the banking system in the crisis can now be fully absorbed by bank capital buffers alone. The job's never done, though, and risks are always evolving. So that's what motivates the actions that the FPC has taken today. Turning first to our risk assessment, the FPC judges that the overall level of domestic risk is now at the standard level. In other words, most financial stability indicators are neither particularly elevated nor subdued. Nevertheless, there are pockets of risk that warrant extra vigilance. Consumer credit has been increasing rapidly. Lending conditions in the mortgage market are becoming easier, and lenders may be placing undue weight on the recent performance of loans in benign conditions. There are also potential risks to financial stability associated with the range of possible outcomes and the number of paths to them under the Brexit process. In addition, the inconsistency between the valuation of some assets, such as commercial real estate and corporate bonds, and the risks implied by the very low long-term interest rates make those assets vulnerable to a repricing, whether through an increase in long-term interest rates, adjustments to growth expectations, or both. Last year, following the EU referendum, the FPC reduced the countercyclical capital buffer, or the CCYB, as it's known, at least to us. We reduced that rate on banks' UK exposures from 0.5% to 0%. This was consistent with the FPC's intention to allow banks to draw on their substantial capital and liquidity buffers as necessary in order to cushion shocks and maintain the provision of financial services to UK households and businesses. That strategy, combined with timely action by the MPC, has worked, supported domestic demand during a period of heightened uncertainty. With domestic risks now back at standard levels, the FPC is increasing the UK countercyclical buffer rate from 0% to 0.5%. In addition, consistent with its stated policy for a standard risk environment and of moving gradually, the FPC is announcing that it expects to increase that rate further to 1% at its November meeting. I'd now like to turn to those risks that merit increased vigilance, and the first relates to consumer credit. Consumer credit growth has far outpaced that of household income over the past year, with notable increases across credit cards, personal loans, and auto finance. In an environment of intense competition, interest margins have fallen and risk assessments by banks have declined, or by lenders, I should say, have declined. Lenders are therefore more vulnerable to losses and stress. Moreover, the short maturities of consumer credit mean that credit quality of the stock of lending can deteriorate quickly. Firms are the first line of defense to ensure that risks are priced and managed appropriately. The second line is supervisory oversight, and in this regard, the third line of defense is macroprudential policy, and today's increase in the CCYB will bolster resilience. In addition, the FPC is accelerating its assessment of the stress losses on consumer credit in the bank's 2017 annual stress review by the PRA has found evidence of weakness in some aspects of underwriting and some reduced levels of resilience against this lending. Turning to the risks around housing, in 2014, the FPC put in place policies to ensure against a marked loosening in underwriting standards and a further significant rise in the number of highly indebted households. These tools require mortgage lenders to assess whether borrowers could still afford their mortgages if at any point over the first 5 years of the loan bank rate were to be higher. And secondly, to limit the proportion of mortgages at loan-to-income multiples of 4.5 and above to no more than 15% of their new mortgages. Following an extensive review, the FPC now expects these insurance measures to become structural features of the UK housing market. That's because they permit significant access to high loan-to-income mortgages for the types of borrowers they suit the best, such as first-time buyers, while preventing the slide of underwriting standards from responsible to reckless. For consistency, the FPC is today clarifying that lenders should test affordability at their mortgage reversion rate, typically their standard variable rate, plus 3 percentage points. A year ago, the FPC took the decision to exclude central bank reserves from its simple measure of bank leverage, an action designed to ensure that the committee's leverage standard did not impede the transmission of monetary policy. Consistent with its commitment at the time to offset any loosening implied by this adjustment, the FPC is now recalibrating the minimum leverage requirement from 3 to 3.25% of non-reserve exposures, subject to a consultation. Consistent with our statutory duty, the FPC will continue to identify and monitor the UK financial stability risks associated with Brexit, so that the necessary actions can be taken to mitigate them. In particular, the FPC will oversee contingency planning in order to help promote an orderly adjustment to the new relationship between the UK and the EU. There are a range of possible outcomes for the UK's future relationship with the EU and a number of possible paths to that relationship. Consistent with its remit, the FPC is focused on scenarios that, however unlikely, could have the greatest impact on UK financial stability. This includes a scenario in which there is no agreement in place at the point at which the UK leaves the EU. That's the type of scenario where contingency planning and preparation will prove the most valuable. Without such plans, financial stability could be affected directly by the impact on the direct provision of financial services and indirectly through macroeconomic shocks. Financial stability issues from the direct effects on financial service provision include, first, the need to make legal and regulatory frameworks for financial services domestic at the point of withdrawal. Secondly, possible disruptions to the flow of new banking and insurance services to UK customers if entities established in the EEA can no longer operate here. Thirdly, spillbacks to the UK from adverse consequences on European clients who lose access to the services of UK-located banks, insurers, and financial market infrastructure. And fourthly, higher costs and greater risks for both EU and UK companies and households if there were fragmentation of market-based finance. In order to maintain consistent provision of financial services to the UK economy, the financial system must be able to absorb any adverse economic shock that could arise from the UK's withdrawal from the EU. The bank's regular stress testing aims to ensure that the banking system has the strength to withstand and continue to lend in a broad range of severe economic and market shocks. And these include the scenarios related to Brexit, which, as the MPC has stressed, have the potential to affect the UK economy through supply, demand, and exchange rate channels. Irrespective of the particular form of the UK's future relationship with the EU, the FPC will remain committed to the implementation of robust prudential standards in the UK financial system. This will require a level of resilience that is at least as great as that which is currently planned and which itself exceeds that required by international baseline standards. Alongside financial and economic risks, the risks from cyber attack continue to build and evolve. At the same time, the FPC has catalyzed measures to strengthen the resilience of the financial system to these risks, including vulnerability testing of all firms at the core of the financial system. The FPC is now setting out the essential elements of the regulatory framework for maintaining ongoing cyber resilience, and it will monitor how relevant UK authorities fulfill their elements that affect the financial sector. So to conclude, the resilience of the UK financial system is strengthened significantly since the crisis. As a result, it's already demonstrated the ability to dampen rather than amplify the impact of shocks on the real economy. As the UK moves into a more standard risk environment and embarks on the Brexit process with its attendant tail risks, the the FPC is committed to ensure that the system continues to have sufficient resilience to withstand potential shocks. By taking the measures announced today and overseeing contingency planning for Brexit, the FPC will help ensure that the people of the United Kingdom can move forward with confidence that they'll be able to access the financial services they need in order to seize opportunities ahead. And with that, Sam, John, and I would be pleased to take your questions.
Okay, if you could give us your name and organisation, wait for a mic, and one question first time round, please. We'll loop back round if we have time at the end. Kamal and then Adam, please.
Thank you. Governor, there's a warning today to the banks about consumer borrowing and the growth in consumer borrowing. But of course, the loans market takes two to tango, so to speak. Right. I just wondered how concerned you are that consumers are borrowing too much, and that if these benign conditions on interest rates, for example, don't last and interest rates rise, that millions of people could find themselves in difficulty and overextended.
Well, I think in terms of messages to consumers, the first is one that's it's the same message whether times are good or bad or somewhere in between, which is that whenever somebody takes out a mortgage or a loan for a new business or an investment, that they consider adverse scenarios as well as positive scenarios. As you just said, whether interest rates can go up as well as staying the same, whether exchange rates could move, and whether the overall pace of growth could change as well. And you know, the track record of the British people, British borrowers, suggests that they do take those factors by and large into account. But certainly in an environment in which we're operating, it is that general advice, that stating the obvious, which is often the advice you get from a central banker, is particularly apt. But the second message is that the resilience of the system has really been strengthened considerably since the crisis, and it hasn't just been strengthened in a manner that looks back and addresses the fault lines that helped cause the crisis, but it has been looking forward. The actions today point to some of those elements of looking forward. We see the risk-taking in the economy moving to a more normal environment, despite obvious uncertainties, and we want to move the level of capital buffers for the banks back up to the level that they should be for that environment. So that's the counter-cyclical adjustment. Anytime you move into more benign credit conditions, there's been fewer defaults, it's a good thing to check your underwriting standards, and that's what Sam Woods and the PRA are doing. And I'm sure we'll speak more to that in a moment. And then thirdly, we all know that this process of exiting the European Union has begun, and there are risks around that process, and so contingency planning needs to be not just put in place, but in some cases activated, and that's all there for a reason. All those steps are there for a reason. So that same consumer, household, or business person, they know that the system is going to be there for them down the road. Again, if they have a good idea or an opportunity to move into a property down the road, the system will be there for them.
Adam Parsons from Sky News. A lot of people will read this report and feel it's a bit like dancing on a pinhead, that it appears to say that lenders are not following criteria, that they're being a little bit reckless in lending money to us as consumers, but that we as consumers are not going out of step. It seems to put all the blame on lenders. Isn't there a middle way that lenders should have their criteria changed, but we as consumers should actually be more careful when we borrow money? I mean, as you well know, consumer credit borrowing has gone up massively ahead of wage growth.
Okay. Well, Adam, thanks for the question. First thing, a bit of context, then I'll ask Sam to expand. If we look at what's happened since the crisis, the British consumer, the British household, has delevered quite considerably. So they paid down a lot of debt. And it's really only been in the last 18 months or so that there's been some modest relevering as a whole. Remember that the growth in consumer credit which is a big number relative to income, is a relatively small part of the overall borrowing environment. And actually, we've been seeing a deceleration in the pace of mortgage credit, for example, in recent months. So overall debt is more or less growing in line with GDP, more or less growing in line with income. So I wouldn't characterize, and I don't think you did, but just for clarity, I wouldn't characterize the behavior of UK households as a whole as taking particularly elevated risks, first point. The second is, though, that in an environment where the economy has been growing for a while, and particularly employment has been growing quite strongly, you have a pro-cyclicality in terms of risk. People are in work, it's relatively easy to get credit, and they continue to make payments. And that's where there is the possibility that underwriting standards of the banks now can slip. They can give people more money, they can broaden, they can take extra risk because their standards have slipped. And that's one of the things that in our second line of defense, I mean, first and foremost, this is the responsibility of the banks and the lenders, but the second line of defense is to take a closer look on the supervisory side. And I'll just ask Sam to maybe speak to just briefly some of the what we call weaknesses that they found there.
So we've done a very in-depth review now of this area of the lenders, and let me just pick out the two main findings. One finding is that resilience is reduced, by which I mean there is less capacity against these specific exposures to absorb losses than there was a few years ago. That's happening for two reasons. One is a simple one, that pricing is coming down. So, for instance, as an example of that, the spread against bank rate on personal loans has come down from about 11% to 7% over the last 4 or 5 years. And that spread is the first thing the banks use to offset losses. The other is that the risk weights have come down over the same period because of the way that banks model these things. And that's an example of, are they controlling sufficiently for recent benign conditions? And again, to give you a sense of that, the average risk weight for a credit card has gone down from 92% to 85%. For other consumer credit lending, it's gone from 109% to 92%. I'm trying to give you a sense here of a reduced resilience. That's the first point. The second point is weaknesses that we have found in underwriting practices and the oversight the banks have of these areas. And we'll put a lot of that in our statement next month. But to pick out one example to give you a flavour of what that is, it goes back to this question about, are they controlling enough the effect of benign conditions? And the simplest way to think about that is impairments are currently low. So an example would be early months impairments. So how much of lending that's been on the book for 9 months is more than 3 months in arrears? Now that number is flat and it is low, it is 0.5%. The question is, when banks are stressing that and saying, well, how much capital do we need to put aside for bad times against that? How are they doing that? And some banks are taking a simple multiple and say, well, in previous financial crises or stresses, impairments have gone up by a factor of, say, 2 or whatever the number is. And therefore we'll just apply that to this very low number. Now it's reasonable to question, is that a sensible thing to do given the number is very low? So that's the kind of space we're in.
Okay, Narina and Peter.
Narina Hertz, ITV News. Governor, can we go back to consumers? And for the layman, for my ITV viewer, you're putting a lot of emphasis in this report on banks and how they need to think that times may be changing and they need to set aside more money, thinking about the future. But shouldn't we as consumers also be thinking about the future and also be thinking that times might be changing? Shouldn't we start reining back on our borrowing?
Well, I'm not going to give individual financial advice, as you can appreciate, Narina. I would note that, and I'll appeal to the MPC's economic forecast, which, as you know, will be updated in the next couple of months. But that paints a picture of growth around the potential rate of this economy. So not as strong as growth has been in the last few years, but not bad either, sort of 1.5%, 1.75% on an annualized basis. Now that depends on a variety of things happening. It depends on a relatively smooth process of exiting the European Union, or expectations at least of a relatively smooth process. It depends on some rotation of demand so that more business investment and more net exports are happening at a time when consumer spending is slowing somewhat. But there's an overall environment of growth. Now, Where the FPC comes in, so that's a central expectation. It's the, if you will, the most likely scenario in the judgment of the MPC. What this part of the bank does, as you know, the FPC does, is we worry about what could go wrong, and the fancy word tail risk. What are the bad things that can happen, and what, if anything, we can do about it? And in effect, what we're trying to do is to strengthen the resilience at the core of the system, because a variety of these shocks that could hit the UK economy, there are shocks over which we have absolutely no control or influence, but we can influence how resilient the system is, and the extent to which the system, whether they're banks, insurers, building societies, other parts of the financial system, have thought about these risks. And what that means for your viewer is that if things become bumpy in the transition, if things become bumpy because of the global economy or some domestic slowdown as well, they can expect, and they should expect, but they also can expect this to be the case, that the financial system will be there for them. There won't be a financial system that is making things worse, that is unnecessarily pulling in the access to credit, whether it's for a first-time buyer of a home or a business person who wants to expand their business. But in the end, it's going to be those individuals who make the judgments about whether they feel it's the right time to buy a property, or they feel it's the right time to make an investment in the business. And what we're doing is making sure the financial system continues to provide them the opportunity for that.
Thanks. Peter Fallison from Reuters Breaking Views. Governor, I wonder if you could talk a bit about how you see the role of interest rates in terms of this whole picture, in terms of exaggerating or reining in potential risks. And I wonder also if you could give us your view on the suggestion that committees such as these and broader central bank responsibilities may have distracted you from the key question of raising rates and controlling inflation.
Okay. In terms of these are important questions in terms of the coordination of the various the works of the various committees, and if I may put in technical terms, the type of policy. So macro-prudential policy, which is the responsibility of this committee, the FPC, and monetary policy, which is the responsibility of the MPC. As you know, we have, each committee has different objectives. They're related, and they support an ultimate objective, which is strong, sustainable, balanced growth in this economy. So we're focused on financial stability, MPC focused on monetary stability. The view we have taken, and I think it has been, is proving effective, is that monetary policy is the last line of defense to address financial stability issues. So we have a fairly wide range of tools, and we have an even wider range of influence that we can take as the Financial Policy Committee in order to build the resilience of the system and promote financial stability. Right now, in the United Kingdom, we're in a situation where actually debt is not growing that rapidly as a whole. It's growing roughly in line with the economy. That's a reasonable situation in which to be. But there are pockets, as we've said, there are pockets which warrant vigilance. So there's elements of consumer credit that warrant vigilance, and we can take targeted action, and we are taking targeted actions in concert with the PRA and the FCA and some of our actions of our own, such as the CCYB, to help address issues related to that. And so in that regard, we don't need monetary policy to do our job. In fact, by doing our job, we allow monetary policy to focus on its job, which is returning inflation sustainably to target in a period of, in an exceptional period. In terms of the second part of your question, whether it's a distraction, I mean, no is the short answer. It takes as much time to decide to hold interest rates as it does to lower interest rates as it does to raise interest rates. You know, I've been doing this for a number of years across two central banks. You know, I can assure you that we devote the necessary time to making monetary policy decisions. It helps tremendously two things help tremendously, and I'll stop with this, in making those decisions. One is to have people with different perspectives around the table, so some diversity around the table, to make decisions, for example, the ones that we've announced today. So we have external members of the FPC who have experience in banking, in market-based finance, who are academics, who have experience in different jurisdictions, are on the FPC, and they provide different perspectives. Just as the individuals you see here provide, we have our own perspectives on these issues. But what we can also bring is some sense of how policy works together across the institution. And the second thing, just to go back to the first part of your question, which is there are definitely complementarities between the policies. It doesn't mean they always move in the same direction, but by focusing on their objectives of each policy committee, you allow the other policy committees to maximize their degrees of freedom, if you will, in order to achieve their goals.
Caroline and then Scott.
Caroline Binham from the Financial Times. It's a question for the Governor and also possibly Sam. There's a section dedicated to China, and last week we saw the regulator in China warn of the systemic risks to exposures to large Chinese companies for Chinese banks. Is this something that's also on the FPC and PRA's radar, given the small but significant exposure that UK lenders have to the Chinese economy? Thank you.
I'll say two words. I think you said you wanted Sam to answer, but I'll just say two words of comment. First is that in terms of our overall risk assessment, in particular in terms of global risks, as you would have seen in the report, we do flag that risks from China are at the top end of those global risks because of the pace of debt buildup, because of some structural issues in the financial sector, and because of the challenges in trying to grow the economy at this rate while decelerating. So it's some inconsistencies in policy. So the macro backdrop, we definitely flag this as a risk, and that's part of the reason why we looked at it quite closely in recent stress tests. But with that, I'll hand over to Sam to speak in more detail.
I'll just add briefly, Caroline, from the micro point of view, obviously we are very focused on the significant exposures that the UK banking system has through some of its banks to Greater China, and as Mark says, the most important lens we have to look at that is what we do in the stress test, and we have a pretty severe test that we apply to that part of the world for the purposes of informing how much capital we want banks to hold. And the second thing, though, which perhaps even more directly on your question, is we of course engage a lot with the Chinese authorities, and specifically in this case the CBRC and the new chairman there. So that is a dialogue which I wouldn't want to offer further comment on, but we are in close touch with them.
Scott Hamilton, Bloomberg News. Can I just ask you about the outcome of the general election? Has that changed the weight of that you attach to particular outcomes of the Brexit talks, or changed the view how you might see those talks evolving? It seems the case that maybe the UK has entered a period of greater political instability or greater political uncertainty. Has that increased the risks to political stability and therefore given greater impetus to banks' contingency plans?
The short answer is no. In terms of our contingency planning and the way we look at these risks, because as you know, Scott, our responsibility is to look at the tail of the distribution. What could go wrong? And as I think I said in my opening remarks, some of those scenarios, however unlikely they may be, and it's not our job to sit back and assess, point estimates of the probability of the end of this process concluding without an agreement. Rather, it's to think about if it were to conclude without an agreement, whether that's a transition agreement or an agreement on the ongoing relationship, what would the financial stability risks be at that point, and how can they affect, what can be done now to help mitigate against them? And that motivates all our contingency planning. That's not to say there wouldn't necessarily be some financial stability issues that could arise with various types of agreements, and of course we do the same process, but we start from the most difficult situation from a financial stability perspective, difficult for Europe, difficult for the UK, difficult for us collectively, and say, what can we do now in order to minimize that? And we're working with firms, we're working with other regulators here, and obviously, as you'd expect, well, it should be obvious, but I'll state the obvious, we're working with European authorities as much as possible in order to help reduce those.
Siobhan and Tim over there.
Siobhan at Kennedy at Channel 4 News. I'm wondering, do you have any detail about the types of people that are racking up debt? Is it households across the board, or is it people using credit cards to supplement low wages, and therefore how worried are you, any sense of tightening making their living standards much worse? And if I'm allowed a part B, how confident are you that the banks will be able to raise the extra financing that you're requiring, particularly banks like RBS and Co-op, for example, who may struggle?
Okay, so two big questions in there. First, in terms of the nature of the debt that's been built up and the nature of the households, as you're probably aware, a lot of the pickup in consumer debt in the last couple of years has been for car finance. And a lot of that has been related to two things. One, the recovery in the car market. People started buying cars again, but also a change in the nature of how they're financing those cars, and a move towards PCP, personal contract purchases, arrangements basically where which from a debt perspective, the entire debt, what would have been a leased amount is expanded to the entire value of the car. So it actually increases the debt statistics there and then. Now, there's risk associated with this, risk particularly to banks, but there is an element of this which is statistical alongside an element which is real, more people buying cars and debt there. We have seen a pickup in consolidation, debt consolidation loans, and we have seen more generous terms in credit cards, particularly around zero balance transfers, and there's some statistics around that in the report. And we are focused, one of the things on which the PRA is focused is the accounting treatment of that and the incentives that that creates, and we'll have more to say about that in a few weeks. To the crux of your question, which is about heavily indebted households and could this amplify the effect? That's what we're concerned about. We're concerned first about the resilience of the banks, and we think they're in a reasonable position, but we should shore a few things up. But then secondly, this overall risk of a high proportion of heavily indebted households that could make a downturn worse. I wouldn't say that what we have seen in the last 18 months has materially increased that risk, just to put it in orders of magnitude. But what we're doing is reinforcing some of the protections that are currently there. The second part of your question related to the countercyclical buffer and this ask well, it's more than an ask actually, but for banks to build that up. I think the first thing to say is that the banks all have this capital at present. And so the question in terms of what's required of them is whether they increase the buffer they have above what they need to have, the buffer on buffer, if you will. The one way I can put it in context is that the level of the countercyclical buffer is when you add it up. When you add the countercyclical buffer with all the other requirements, you get up to, at most, about a 4% leverage ratio. So just a simple capital relative to the amount of assets of the bank, okay? At present, the banking system has about 5.25% leverage ratio. So we're reapportioning capital within the system. I'm not suggesting that that doesn't have an impact. I'm not suggesting that banks won't add a bit of capital in order to build it up. But there is considerable lending capacity. And I'll finish with this, which is, again, to go back to your viewers or people who are watching. Last year, the UK economy net lending to the UK in the UK economy was about £65 billion. The difference between that 4% and the 5.25%, the amount of room they have, even after they've built up the buffer, is equivalent to about £250 billion of lending capacity. So the capacity is there, again, but the capacity is there, and banks will release it for good ideas and viable mortgages.
Tim Wallace at the Daily Telegraph. Governor, are banks gaming the system? It looks as though they're stretching the rules on risk weightings, on the loan-to-income limits, on the affordability tests. Are they still misbehaving? Is this a cultural problem?
On the, I would characterize the second in terms of the underwriting standards and the type of scenario Sam Woods described a few moments ago. I don't think that's gaming. I think that is forgetting some of the lessons of the past, or not necessarily learning, fully learning the lessons of the past, or being too, in some cases, and this isn't a general point, but being too model-driven as opposed to layering enough judgment on top of models. And that's the kind of thing that should be picked up with supervisory reviews, as the PRA has just done, or stress testing. In terms of the mortgage restrictions, which you referenced, we'll take a neutral view of that. Banks now have the appropriate clarity to ensure that they use the right reversion rate, which in most cases is the SVR. So we've just provided that clarification. In the end, if they'd been using the SVR, the rate would be 7%. In other words, the rate at which they're testing people's ability to borrow in a higher interest rate environment. At present, I think it's about 6.8% at present. So there's something in there, but I would caution against over-interpreting it. But it levels the playing field for lenders by providing this additional guidance.
Jill, and then Graham up at the back there.
Jill Treenor, The Guardian. I just wanted to ask you about the timing of this decision to talk about consumer credit today. One of the charts you provide appears to show that consumer finance has been growing much faster than household income since about early 2014, and I'm wondering why now? Should it have been done earlier?
Well, I'll start and then I'll have John amplify. I think the first thing is the nature of what long period of weak consumer credit growth starts to recover as the economy recovers, and recovers particularly in auto finance, which is relatively, which was both understandable and relatively low risk for the system. With the broadening and with the overall risk, the shift in the overall risk environment made some sense. And just as a general point, anytime we see something growing quite rapidly, we will take a closer look at it. Debt aggregates growing quite rapidly, to take a look at it to see if there's issues around it. But
yeah, I'd make a couple of points. I mean, first, it starts growing around 2013. I think it's averaged about 7% a year from 2013 to now. As Mark said initially, that's driven by very high rates of car finance. It's only over the last year or so that credit card lending and other forms, personal loans, have tended to kick in. Over that period, general lending, aggregate lending in the across the economy to households was growing actually slower than GDP. So when you looked at the overall debt position, it was debt was not growing at the same rate as GDP over much of that period. And I think the issue for us is this is 200 billion stock of lending as against 1.4 trillion on mortgages and others. At what point, do you say this is growing fast and it's creating a problem, particularly a problem for the resilience of banks? We stress tested it. We stress tested every year. As the Financial Stability Report makes clear, the stock turns over quite quickly, so you need to keep doing that. But now I think is the point one needs to look at this question of our underwriting standards starting to slip, and is there a risk of this growing too fast? But I think if you put it over the general picture, we've been as you know, we've been watching it for over a year or two now, and this just seems the point now to check on underwriting standards and then bring forward the stress test so that we can look to see whether, as the stock turns over, the risks are growing. But I'd just say it's within that overall environment of credit in the economy growing at the same rate as the economy.
It's Graham Hiscott from the Daily Mirror. Actually, annoyingly slightly answered my question last answer, but it was about car finance. Do you think that is there a concern about the ease at which people are able to obtain car finance, certainly relative to mortgages? It comes back to the concern you might have about underwriting. Yeah. And is car finance one of your specific pockets of risk? And do you foresee any targeted action, targeted measures that to particularly clamp down on standards in that market?
Yeah. Well, it's we're not at present. We're not contemplating anything specific targeted to car finance. First point. Second is that I think from a banking perspective, we should put the growth in car finance in some context. And if you'll bear with me for a second, the exposure of the bank is twofold. Obviously, it's the individual continues to make the payment, which they tend to because people need their cars in general. But then secondly, at the end of the PCP contract, how these are financed at present, then the bank has exposure to the residual value of the car. It's guaranteed, effectively, the residual value of the car. And so the question is, what could happen in a scenario where a lot of people don't retain their car, there's excess used cars, and what could happen to values to those cars. And so in the report, we do an analysis which shows that if the value of cars, those cars were to go down by 30%, everyone gave them back, the value goes down by 30%, and obviously the more people give them back, the more likely values are going to go down. What would be the impact on bank balance sheets? And it would hit about 0.1% maximum. It's actually 0.9, I think, but 0.1% maximum off that Tier 1 capital ratio, which I gave to you earlier. So in other words, it's not 15.6%, it's 15.7, it's 15.6. So it's it's something, but it's pretty negligible from a bank perspective. The other big exposure to this sector is the dealers themselves or the auto companies themselves, and obviously. It's a question of that's not so much a financial stability risk for us. It's an issue for those companies themselves, and they'll have bigger issues if they're not selling new cars and they're getting a lot of used cars back. But they're the experts and they can make those judgments. So just to summarize, I wouldn't say this is explains part of why things have built up. So you're right to ask about it. We're relatively sanguine about the exposure of the banking system to this sector as a whole, and we detail why that is the case. But the overall picture of a more rapid growth in consumer credit does bear watching, and in some other areas we've seen some underwriting standards, some weakness in underwriting standards and had action. And then just as a whole, when we see this growth in consumer credit, and we look at the overall risk environment, we say, okay, now's the time to start for banks to rebuild or to add additional buffers of capital, I should say, add additional buffers of capital, which is why we've made the bigger decision, which is around this 0.5 percentage point increase in the countercyclical buffer with a pretty clear steer, not a guarantee, but a pretty clear steer that when we sit down in November, we'll probably raise it another 0.5 percentage point. And the only reason as we sit here today, we're doing it in 2 steps, is in order to give firms the chance, banks enough time to build it up in a gradual fashion. Thanks.
James over there, and Dan right at the back, please.
Hi, James Salmon from the Daily Mail. I mean, a fairly obvious question, but isn't the boom in consumer credit a fairly inevitable result of you keeping interest rates for so low for so long?
No, I think the short answer, no. When you look at borrowing rates on consumer credit, the range of travel of bank rate, whether it's at 25 basis points or even a percentage point, That's a very small component of the overall cost of consumer finance. We have an economy which we have been providing support to which we've been providing support in terms of monetary policy, and ensuring that the financial system is open. The net result of that, at present, in an environment of strengthening and broadening global growth, has been an economy that is at least on, well, if I take not the most recent growth figures, but if I take the last year's growth figures, so if I flatter it in that regard, it's an economy that's growing at about its rate of potential, no more. So I think the overall context is important as well.
Hi, Dan Hinge, Central Banking. I wondered if you could elaborate a bit more on any work you've done on the ways in which the distribution of debt among groups in the economy and possibly financial institutions as well kind of affects the propagation of shocks to the economy.
Yeah. John, do you want to?
Yeah, I think that's it's a very important part of our work, particularly our work on housing. So our work on housing and the insurance measures we put in place to stop the build-up of mortgage debt is really focused on the more highly indebted groups of households. The limits we set in 2014, which was no more than 15% of the flow of new mortgages at loan-to-income ratios of 4.5 and a 300 basis point affordability test, those were designed really to target households not getting into the range of having debt service of 40% of their income. And if you look in the report, you can see evidence that when we went through the recession after the financial crisis, the cutback in consumption in the economy, the stress on the economy from the households that had mortgage debt or debt to income in the or debt service ratios in the sort of 30s and 40s, and debt to income in the sort of 3-4 times, the cutback by those groups on consumption was much greater than elsewhere. And if you look, I think there's evidence in the report also of Denmark and Norway and other economies where that's happened. So the action we take on housing is really built around that analysis of cohorts of highly indebted borrowers, how they react to stress, how they react to the economy as a whole, and then how that feeds back on the financial system.
Okay, Gemma and Jason.
Thank you. Gemma Tetlow from the Financial Times. One of the risks that you point to in the report is the fact that some assets look overvalued, and particularly commercial real estate assets look overvalued. And you say that that could quickly and rapidly unwind if people try and sell out of those rather illiquid assets, which is exactly what we saw happen after the Brexit vote last summer. Has anything changed in that market to suggest we couldn't potentially see something rather similar to the very rapid breakdown that we saw last summer?
Well, there's maybe I'll make a distinction between the closed-end trusts, real estate trusts, and the broader commercial real estate market, because and the former are relatively, as you know, a relatively small proportion. They own a relatively small proportion of commercial real estate in the UK. And actually, I'll get John to just speak to that experience and what's changed and how we think about it. But let me go to the bigger issue, if I may, which is this disconnect which we're trying to highlight and which gives us some concern between the valuation of some assets, and that we would include corporate debt in this as well, and commercial real estate relative to growth outlooks that are implied by risk-free assets. So I think we all know where roughly where the 10-year gilt is, and you can have different views of term premia and expected path of bank rate, but effectively it's saying negative real growth. I can round it up and say very modest real growth for the UK for a very long period of time. And so, well, one is influenced by the discount rate. One also has to take a signal, or not, about what that discount rate implies about growth. for the economy, and what therefore it would imply about rents and terminal values and other elements of commercial real estate. And so somewhere between the two, and I mentioned it, it's in the report, I mentioned in my opening remarks, there will be a reconciliation at some time. Either those rates are going to rise because expectations of growth and risk premia are going to go up in the UK. So those, when I say the risk-free rates, and when I mean risk premia, I mean term premia. Or there's going to be a gradual adjustment, or an adjustment, gradual or more abrupt, of, for example, commercial real estate values, or somewhere in between, or both of those are going to happen. And but it does mean that we need to be aware to some of those risks, and I'll speak to one and hand to John for the other. And so one of the things you would expect us to worry about is, what does this mean for the UK banking system, and how much exposure do they have to commercial real estate? And what you see, and it's in the report, is that actually UK banks, the sterling value of their exposure has gone down considerably since the crisis. So even though there's been a lot of activity in the sector, it's gone down to around 75 billion sterling from more than 150 billion in 2008. And as a proportion of their common equity, it's gone down by an even greater proportion, because of course their equity's gone up over that time, that their actual exposure's gone down. So they have actually, in historical terms, quite a modest exposure to commercial real estate. Above and beyond all that, though, we are stressing commercial real estate in our stress test to about a 40% fall in prices, so we can then flow that through to see what it actually means for UK banks, make sure they have enough against it. So we're concerned about the risk, and we're taking action on the banking side. Then the other element of it is to think about, how does this play through the fund side, and I'll hand to John.
Yeah, I'd maybe make a general point that market-based finance, as opposed to bank finance, has grown very considerably, probably doubled since 2005. A lot of that is open-ended investment funds that promise their investors daily liquidity, that you can have the value of your investment out on a daily basis. As a general point, I think it's important that the liquidity promise that the fund makes is matched to some extent to its investment strategy, the things it invests in, whether they're liquid. And maybe the most sort of striking example of that is open-ended funds that have real estate investments, because real estate is just very hard to liquidate, to sell quickly, to make liquid quickly, and it's quite hard to value when prices are moving. And that's what we saw happen after the referendum. That prices dropped, the funds couldn't value, they couldn't sell fast enough, and they took a range of action from gates to discounts to effectively close. That seems to have operated without a more general spread to other open-ended funds that invest in other sorts of assets, and the funds reopened eventually, and the FCA are doing some work now just to look at how that operated. But I think it goes to the more general issue that one needs to think carefully about how this change in finance, and particularly the role of retail investment funds at a time when market values are changing quickly, whether that could transmit stress. So I think it's something we're looking at. Again, it's in the report you'll see there's a discussion of it under the section of resilience of market-based finance. And I think generally the point I want to say is that I think it's important that funds' investment strategies and the liquidity they offer sort of are well matched and come into line. I think the UK is one of the only countries that has open-ended property funds that promise daily liquidity.
Yeah.
Hi, Jason Douglas from the Wall Street Journal. Could I just ask you, please, about one line that jumped out at me from the report, where you say, absent consistent implementation of standards internationally and appropriate supervisory cooperation, the FPC would need to assess how best to protect the resilience of the UK financial system. Could you just describe a little more about what you mean by that, please? Is this primarily a sort of Brexit-related issue, or do you still harbour some concerns about, a weakening commitment to some of the international standards that we've had in the past few years? I'm thinking in particular of what administration, as I'm sure you can imagine.
The last bit?
I'm thinking in particular of the Trump administration, as I'm sure you can probably imagine. Thank you.
Well, I think the, first point, which is that we believe in an open system, and we have worked with others in order to put in place the components of an open system, which are higher international standards that meet not just or address not just the fault lines that caused the crisis, but provide appropriate resilience for the world in which we all now operate. Having just those standards is an extremely good start. Having them transparently implemented improves it, but it very much helps to have open and deep supervisory cooperation. If you have globally systemic institutions, as we all still do, and they operate in your jurisdiction, you want to be able to talk to their home regulator. You want to coordinate how you would resolve such an entity if you had to address a broad range of issues. So you need both. You need the standards and you need the supervisory cooperation. And the good news is that there's been tremendous progress on the former, and there's been a lot of development on the latter. We want to, as much as possible, reinforce that. You asked about the U.S. administration, and I'll just say a couple words on that, which is that these are the types of discussions that we've been having with them. They've been very productive across the range of U.S. authorities, from the Treasury to obviously the Federal Reserve. You know, the Mnuchin report, Secretary Mnuchin's report of last week, 2 weeks ago, you know, really looks at three buckets of risks. One is areas where the U.S. Has taken measures uniquely. And so the Volcker Rule would be an example of something that's been done in the U.S. but hasn't been done elsewhere. Ring fencing would be an example that's been something that's been done in the U.K., not done. So we all have certain things that are idiosyncratic or unique to our circumstance. And if somebody wants to change elements of that, it doesn't have an international spillover necessarily, and it's obviously all of this is within their rights, but you know, very much so. Secondly, there are certain areas where the U.S. is just as we are in the UK, where they are super equivalent to international standards. The supplemental leverage ratio would be an example of that. And again, if they're adjusting something like that, that's entirely appropriate. And then the third area are areas where there may be a view in the US or the UK or Europe or other jurisdictions where certain regulatory initiatives overlap, duplicate, don't fit together well, and they should be adjusted. And one of the big messages out of the FSB now is that that's exactly the type of situations that we're trying to look at. And the terminology we're using is dynamic implementation. In other words, looking at how various initiatives fit together, and do they have either unintended consequences, or are they inconsistent or just inefficient because you have multiple measures doing the same thing. I'll finish with an example which was noted both in Secretary Mnuchin's report and is going to be a focus of the FSB, which is around the interaction between the derivative reforms and the definition of the leverage ratio. There is an inconsistency there in the opinion of many, including many in this institution, between having client margin in the leverage ratio. It's a risk-free asset because it's a pass-through, which reduces the incentives to centrally clear, and arguably reduces the overall resilience of the global system. So the line in the report, you're right to put your finger on it because it opens up a number of broader issues, but I would at this stage come at it positively, and to really finish this time. That was that's been the message, and will continue to be our message around future relationship with Europe, in that we have the building blocks, we have the supervisory cooperation, and we will work as best we can to develop a model that maintains them.
Time for just one more. Jasper.
Jasper Jolly from CCAM. Just going back to the commercial property, the London West End office prices seem extraordinarily far above your sustainable range calculation. I mean, you say it's unsustainable. what kind of timeframes are we talking, and what will happen on a kind of broader level when those prices start to come back down to the levels that you think are sustainable?
Well, what's unsustainable is the combination of very low risk-free rates and the levels of valuation. Now, two things can happen. One is those risk-free rates can go up because there can be a revised view of the growth outlook, and that could be more consistent with implicit rents with commercial real estate, or there could be adjustment on the latter, or either. I'd be foolish to try to put a timeline on anything. Things that are unsustainable go on for much longer than you expect, and then the truism is that when they adjust, they happen quicker than you think.
Sorry, one very, very final one, just straight behind you.
Adam Linton, Ranscork. So today we saw the counter-cyclical buffer increase from 0% to 0.5 after previously being cut to 0%. The upward bias is now for 1% in November. But what potential hesitations could you have from moving back to 0.5 to 0, or from 1 to 0.5 if we get there? Considering we have 640 days left of Brexit negotiations, do you think that could potentially cause any concerns in the banking sector with regards to communication between yourself and the sector, particularly given the differing views we saw on the MPC with the 5-3 vote split and the subsequent repricing we've seen in financial markets for that increase in the bank rates?
Well, I think it's a good question. I think the basic point is that we took a view as a committee more than a year ago that in what we're calling a standard risk environment, which is covers a pretty wide range of paces of growth in the economy, growth in whether it's consumer credit or business credit or lack thereof, asset prices, other things. In a standard environment, the resting place for this countercyclical buffer should be around 1%. So the question has been, well, how do we get from 0 to 1 in a responsible manner, a way that banks can build it up? And when we cut the rate, we had started that process more than a year ago, but then the referendum happened, concerns about access to credit. We wanted to take those concerns right off the table in order to support the economy, and in conjunction with the MPC's action, I think did provide important support to the economy and have helped with the transition. And transition from if you recall this press conference a year ago and the events surrounding it at a time when there was heightened uncertainty and real concern, including about the financial sector, unwarranted, and this was one way to dispel those concerns, which we did. It helped move the economy to a standard environment, so the question really is, how do you get the rate up to the level that we think it should be? And we've designed our whole capital framework to be consistent with having a countercyclical buffer around 1% in standard times. I think the industry absolutely understands that. It won't be a surprise that we're trying to get there. We could have taken a decision today just to go all the way there in 12 months' time, but the committee's view was that that wasn't consistent with giving time for a gradual build. To finish, your questions around what could happen 640 days from now, as you put it. Well, we want a system that is as resilient as it needs to be, both in terms of capital and in terms of softer items around contingency planning, to prepare for any possible outcome at that point in time. An agreement, no agreement, a transition, no transition, etc. And so having the counter-cyclical buffer, all things being equal, having it at the level it should be would be part of the necessary resilience. So I would hope that everyone can understand that, and certainly from the view of the committee, which operates under consensus for the FPC, that's exactly what that we feel is appropriate for a variety of reasons.
Thank you all for coming. We look forward to seeing you again next time. Thank you.